U.S. homeowners sitting on a gold mine? According to a new report from ICE Mortgage Technology, mortgage holders withdrew less than 0.5% of their total tappable equity at the beginning of Q3, which is half the average rate we saw last decade. That's equivalent to an estimated $54 billion over the past 18 months in missing withdrawals that might have otherwise stimulated the broader economy, according to my next guest. For more, we're joined by Andy Walden, ICE Mortgage Technology Vice President of Enterprise Research. Andy, we love following your journey, by the way, from home to ICE to just the whole thing. Welcome. It's good to see you again.
Good to see you. Thanks, Kelly.
So what I ponder when I think about this is if/when the economy weakens and rates fall, could homeowners all of a sudden start to tap this more vigorously?
Yeah, I absolutely think that's a possibility. I mean, there's a couple different ways they do it. One is with cash out refinances. We've already seen 30-year rates start to ease over the last month or so. And then the other one, second lien home equity lines of credit. And as the Fed starts to ease, or at least they're expected to start to ease late next year, you could see it become a little bit more affordable to start to utilize that equity.
How expensive is it now? I mean, when I've looked at home equity prices, they're typically quite up there in terms of the borrowing rates.
Yeah, if you look at our McDash Home Equity database, it says the average rate in September was about 9.3%.
Wow.
On a second lien home equity line of credit, up 3 percentage points from the same time last year. Highest it's been since we started collecting that data back in 2008. And so it's become considerably more expensive, especially as the Fed has started to tighten. Obviously, HELOC's tied to the prime tied to the Fed funds rate. So, as the Fed has put pressure on the broader economy, certainly putting pressure on those HELOC interest rates as well.
And we know 5, 10, 15 years ago, these were used by a lot of people to finance renovations, sometimes vacations, sometimes college educations. I guess if they needed to, it would still be there to tap, but it just would be quite pricey.
Yeah, absolutely. I mean, it's still available, right? If you look at the amount of equity that folks have, we saw a little bit of a pullback as prices corrected late last year. We're within 3%, right? You mentioned the number earlier, $10.5 trillion of equity out there that could be borrowed while still keeping a 20% cushion in their home. So the equity is there. It's just a matter of how much do you need it, right? How much do you want to borrow it? Are you willing to pay 9% on it for a HELOC? Are you willing to pay over 7% on a cash out refi to start to utilize that equity?
One more quick question on this. Do you think that people, I'm thinking of kind of the servicers, the providers, people in the home lending space, do you think they would try to get more creative to bring those rates down and stimulate more activity, or would it just not be worth it for them?
We haven't seen it yet, right? So when you look at the HELOC to prime interest rate spread, which would show you how aggressive lenders are being in terms of that equity lending, you saw it get really low last year. In fact, there was a point last year where, one, you could get a HELOC below prime, and two, you could get a HELOC interest rate below the 30-year fixed. As there's more uncertainty about the broader economy and as the dynamics have shifted a little bit, you've seen those spreads widen, which suggests that home equity lenders aren't being quite as aggressive as they were last year, and not even as aggressive as they were in the pre-pandemic era either. So we haven't seen that yet in terms of aggression and getting creative, but certainly could, really depending on what we see in economic and broader risks out there in the market.